All right, this problem will estimate the weighted average cost of capital for XYZ Industries. XYZ Industries has $100 million of outstanding bonds, and they have a yield to maturity of 5%, and the firm has 20,000 shares outstanding common stock that sells for $28 per share. So if we're doing the total capital, the amount of debt is $100 million, and the amount of equity would be 2 million shares, or I'm sorry, 20 million shares, and they sell for $28 a piece. So the total capital would be $660 million. Okay? And if we were looking for weights on this, $100 million of their $660 million, or about 15%, is debt, and the rest is equity. All right, so there's my weights, and they're going to add up to 100%. So it's about 15% debt, 85% equity. All right, so what else do we know? The cost of debt is equal to the yield to maturity times 1 minus the tax rate. And we see down here that the firm's marginal tax rate is 35%. So if the yield to maturity on the bonds is 5% and the tax rate's 35%, then the cost of equity capital, or the cost of debt capital rather, is 5% times 1 minus 0.35, and that comes out to 3.25%, or 0.0325. Now I'm going to label costs using percents and leave the weights as decimal form. Okay, so there's my cost of debt. Now, to calculate the cost of equity, I have several different options here. I could use discounted cash flow because I know the current price, the expected dividend, and a constant growth rate of dividends, so I can use discounted cash flow. All right, so when I'm doing cost of equity, if I'm using the DCF method, that takes the cost of equity is equal to the dividend 1 year from now divided by today's price, the price at time 0, and adds that long-term growth rate. So the next year dividend is given as $1.32. Today's price is given at $28. And the long-term growth rate is given up here in the problem as 6%. All right, so it's been growing at 6% for 20 years and is expected to continue that into the future. Okay, so if that's 6%, then the DCF cost of equity, is D1 over P0, and then add that to G. And the cost comes to, let me format that so it's not quite as many decimal places. It's a glitch in Excel. It's been there since I've been using Excel, where it adds 14 decimal places when you don't want it. So under DCF, the assumption would be that the cost of equity capital 10.71%. The bond yield plus method simply takes the takes the yield on outstanding bonds and then plus a fixed number. And I believe the analyst here said that the cost of equity capital runs about 5% higher than the yield to maturity on the bonds. So I need to know the yield to maturity on bonds, and that's given in the problem at 5%, and then the risk add-on would be 5%. So the bond yield plus cost of equity would be that plus that, or about 10%. Now, when you're actually using these numbers in the real world, what you're going to find is that you're never going to get the same number from any two of these methods that are in play. And we go to the third one. That's the capital asset pricing model. And for the capital asset pricing model, let me actually just move this down. The capital asset pricing model says that the cost of equity is equal to the risk-free rate plus the market risk premium times the beta for this particular company. So I need a risk-free rate, I need a market risk premium, and I need the beta for this particular stock. So if we look back up here in the information given, I have a risk-free rate of 3.5%, a beta of 0.85, and a risk premium of 7%. Okay, so the risk-free rate, 3.5%. The market risk premium is given in the problem at 7, and the beta is 0.85. So the CAPM cost would be 3.5% risk-free rate plus 7 times 0.85, and it comes out a little bit lower. It comes out to 9.45%. So what I have here are three different costs of equity capital. And which one should I use? Well, I'll tell you another dirty little secret. They'll never come out in the real world looking as close as this. People do it a lot of different ways. Some people suggest using the highest one as a conservative number. Some people say average all three. Some people say pick the one in the middle. If we were to pick the one in the middle, the median, it'd be 10%. So why don't we go with that? The equals the median of this one, and this one. The median's the number that's right in the middle. So I didn't need all that fancy Dan arithmetic, but now that I have it here, I've left myself an audit trail, so it wouldn't be that hard for me to go back and figure out why I picked 10%. So if I do weight times cost here, and then add those numbers together, that'll give me my weighted average cost of capital. Alright, highlight in green so I'll know that to make it stand out a little. And then I want the percent and add a couple of decimal places. That's right at 9%. Alright, so in the real world, in college world, you enter as many decimal places as the question asks you. In the real world, you would probably just round that to about 9%. All right, but that's the weighted average cost of capital. You come up with the weights, and the weights are either given to you as target weights, or you estimate them based on the market values of the equity and debt components, $100 million of debt, and the market value of $560 million of the outstanding common shares gives you total capital of $660 million. 15% of it's debt, 85% is equity. The after-tax cost of capital for debt is the yield to maturity times 1 minus the tax rate. We have 3 different methods of calculating the cost of equity capital, and any one of them is preferable based on individual choice. In the real world, for large companies, they tend to use the capital asset pricing model simply because it's usually more conservative. A lot of companies don't pay dividends or don't have stable dividends, so they perhaps can't use the discounted cash flow. And the bond yield plus method is a good check number against whatever you come up with the CAPM. But the CAPM tends to be the one that more people use. Not that it's more accurate, it just tends to be the one more people use because it makes sense. All right, to finance wizards anyway. All right, so there's the weighted average cost of capital for XYZ Industries right at 9%.